Friends, thank you for being here today. We stand at a precipice in global financial history, a moment that future economic historians will likely look back upon as the definitive turning point for the fiat currency experiment. If you have been sensing a shift in the economic atmosphere, a feeling that the traditional rules of investing and saving no longer apply, or that the volatility we are witnessing in the markets is symptomatic of a much deeper structural fracture, your instincts are entirely correct. We are not merely looking at a market correction. We are witnessing the mathematical, inevitable collision between paper derivatives and physical reality. Yesterday, the markets witnessed a volatility event in silver that left many casual observers baffled. We saw the price surge to $92 per ounce, a level that reflects the true scarcity of the metal, only to be violently hammered down to $87 in the illiquid overnight trading hours. To the uninitiated, this looks like a rally failing. To those of us who study the plumbing of the global banking system, this was something far more significant. It was a desperation move. It was a survival reflex by institutions that are currently staring into the abyss of a $396 billion loss, a loss large enough to wipe out the equity of some of the world's most storied financial institutions. Before we go further, I want to ask you a question, and please be honest in the comments below. When you saw that price drop yesterday, what was your first instinct? Did you feel panic, or did you see it as a buying opportunity? Let me know your thoughts. I read every comment. Today, we are going to dispense with the noise of the mainstream financial media. We are not interested in the daily fluctuations of stock indices or the superficial commentary of cable news pundits. Instead, we are going to conduct a forensic analysis of the data. We will look at the balance sheets of the bullion banks, the historic shift in central bank reserves that occurred on January 15th, and the screaming signals coming from the physical supply chain. The thesis is simple, yet terrifying for the establishment. The banks are trapped in a short position they cannot cover. The physical metal is gone, and the only way out is a revaluation of precious metals that will redefine wealth for a generation. To truly grasp the magnitude of this crisis, we must first examine the mathematics of insolvency. To understand the panic we are seeing in the paper markets, we must understand the scale of the liability facing the commercial banks. For decades, major institutions, names you know well, such as Bank of America, Citigroup, HSBC, and JP Morgan, have managed the price of silver through the derivatives market. They sell paper contracts, essentially promises to deliver silver that they do not possess, to manage volatility, and, in many cases, to suppress the price of what is essentially a barometer for inflation. However, this game of musical chairs works only as long as the price remains contained, and crucially, as long as investors are willing to hold paper contracts rather than demanding the physical metal. That dynamic has shattered. According to the latest available data regarding open interest and bank participation reports, the commercial banks are currently holding a net short position of approximately 4.4 billion ounces of silver across all maturities and derivative structures. In a low-price environment, this liability is manageable. It is a line item on a balance sheet, a cost of doing business. But we are no longer in a low-price environment. Let us do the arithmetic together. At a market price of 90 per ounce, a level we breached just yesterday, that short position of 4.4 billion ounces represents a financial liability of 396 billion. To put that number into perspective, we must look at the capitalization of the entities holding the bag. As of the most recent market close, the market capitalization of Bank of America hovers around $250 billion. Citigroup is valued at approximately $120 billion. The math is stark and unforgiving. If the price of silver sustains a level of $90 to $100 per ounce, the losses on these short positions would exceed the entire market value of these institutions. This is not a matter of a bad quarter or a dip in earnings. We are discussing technical insolvency. If these banks were forced to mark these positions to market and cover them at 100 per ounce, they would effectively be bankrupt. They would require an immediate recapitalization by the Federal Reserve, a bailout that would dwarf what we saw in 2008. This reality explains the price action we witnessed yesterday. When silver hit $92, the algorithms at these trading desks signaled a code red. They did not sell because the asset was overvalued. They sold because they had to. They dumped massive volumes of paper contracts into the thinly traded Asian and European sessions to trigger stop-loss orders on leveraged traders. By forcing the price down $5 in a matter of hours, they relieved the immediate pressure on their margin requirements. They bought themselves another day of survival. But here's the critical takeaway for the prudent investor. Price suppression via paper dumping is a finite strategy. It burns capital, and more importantly, it does not create a single ounce of physical silver. It creates an illusion of supply, but it does not solve the structural deficit. The banks are fighting a war against the fundamentals of supply and demand, and history teaches us that while market manipulation can distort prices in the short term, the physical reality always wins in the end. I'm curious to hear from those of you who lived through the 1980s silver spike or the 2008 crash. Do you see similarities between the bank's behavior then and what they are doing right now? Share your experience in the comments. Your historical perspective is valuable to this community. This brings us to a historic turning point, a moment I call the crossing of the Rubicon in global finance. While the commercial banks are fighting for survival in the future's pits, a far more significant shift has occurred at the macroeconomic level, a shift that fundamentally alters the landscape for the US dollar and, by extension, precious metals. On Thursday, January 15th, a quiet but seismic event occurred in the world of central banking. For the first time since the mid-1990s, a span of 30 years, the total value of gold held in global central bank reserves exceeded the value of US Treasury securities held by those same institutions. We must pause to appreciate the gravity of this metric. For half a century, since President Nixon closed the gold window in 1971 and ended the Bretton Woods system, the U.S. Treasury bond has been the undisputed pristine asset of the global financial system. It was the reserve asset of choice. Developing nations, oil exporters, and trade partners parked their surplus wealth in American debt because it was liquid, it paid interest, and it was considered risk-free. That era has officially ended. The risk-free designation of U.S. debt is being challenged by the very nations that used to be its biggest buyers. Why is this happening? It is the rational response to two converging factors: the weaponization of the dollar and the debasement of the currency. First, the geopolitical aspect. When the United States froze the dollar reserves of the Russian central bank following the onset of the Ukraine war, it sent a shockwave through the global south and the BRICS nations. The message was clear: your dollar reserves are not your property. They are leased privileges that can be revoked if you cross Washington's foreign policy red lines. Nations like China, Saudi Arabia, India, and Turkey realized that holding their national savings in U.S. debt was a national security risk. They began to diversify immediately, not into the euro or the yen, which are subject to similar political risks, but into the only neutral reserve asset in the world: gold. Second, the fiscal aspect. The United States national debt has now surpassed $36 trillion. The interest payments alone on this debt now exceed the defense budget. We are witnessing the exponential phase of debt monetization, where the Federal Reserve must print currency to buy the bonds that no one else wants. Foreign central bankers are not mathematically illiterate. They see the trajectory. They understand that the purchasing power of the dollar is being sacrificed to keep the government solvent. The crossover event, where gold reserves surpass Treasury holdings, is the global vote of no confidence. It is the world crossing the Rubicon. They are stating, with their balance sheets, that they trust a yellow metal that pays no yield more than they trust the full faith and credit of the United States government. This leads to a critical question for every American saver. If foreign central banks don't trust the US dollar anymore, should you? Who do you trust more to protect your retirement over the next decade? The Federal Reserve or gold? Type Fed or gold in the comments below. This rotation into gold is the foundation for the silver thesis. Silver is often described as high beta gold. It moves in the same direction, but with much greater velocity. As the monetary premium returns to gold, as it becomes the primary reserve asset again, that monetary premium will inevitably flow into silver. But unlike gold, silver has a dual identity. It is money, yes, but it is also an indispensable industrial metal, and that dual demand is creating a squeeze that the paper markets can no longer hide. Now let us turn our attention away from the paper derivatives and look at the screaming signals coming directly from the physical market. If the paper price of silver were an accurate reflection of reality, we would expect to see ample supply available for delivery. We would expect a market in contango, where future prices are higher than spot prices to account for storage and insurance. Instead, we are seeing the exact opposite. We are seeing a market in extreme distress. There are two specific indicators from the physical market that prove the 87 spot price is a fabrication. The first is the lease rate. For those unfamiliar with the mechanics of the wholesale bullion market, the lease rate is effectively the interest rate one must pay to borrow physical silver. In a normal, healthy market, lease rates are negligible, often between 0.5% and 1%. This is because there is typically plenty of 1,000-ounce bars sitting in vaults in London and New York, and owners are happy to lend them out for a small return. Currently, however, silver lease rates have gone vertical. We are seeing rates spike to 5%, 10%, and in some specific intraday markets as high as 20%. Ask yourself, why would anyone pay 20% annualized interest to borrow a bar of silver for a month? There is only one answer. They need the metal immediately to fulfill a manufacturing obligation or to cover a short position, and there is no metal available to buy at the spot price. This is a condition known as backwardation. It is the market screaming that there is a physical shortage. It is the ultimate signal that the spot price is too low to bring supply to the market. While the banks smash the paper price to paint a bearish picture on the charts, the lease rates are telling us the truth. The vaults are empty. The second indicator comes from the east, the Shanghai Futures Exchange, SFE. While Western pricing is largely determined by the COMEX in New York, a paper derivatives market, the Shanghai Exchange has become increasingly dominant in setting the price for physical delivery. On January 15th, the SFE announced a dramatic change in its rules. They slashed the maximum position limit for silver contracts from 7,000 lots down to 3,000 lots. This is a massive 57% reduction in position limits. An exchange does not take such drastic action in a calm market. They do not restrict trading volume when things are functioning smoothly. They take these measures when they are terrified of default. Shanghai is seeing a wave of delivery requests that drains their inventory. By forcing traders to reduce their position sizes, they are attempting a soft force majeure, trying to slow down the run on the bank before they run out of metal completely. This action in Shanghai confirms that the shortage is not a localized phenomenon in New York or London. It is systemic. The world is running out of silver at these prices. The industrial consumption, driven by solar panels, electronics, and batteries, is devouring the annual mining supply, while investment demand is soaking up the rest. The buffer stocks are gone. The exchange limits are being tightened. The lease rates are spiking. All of these are classic precursors to a price explosion. I want to verify the situation on the ground with you. Have any of you tried to buy physical silver from your local coin shop or online dealer recently? Are you seeing delays, high premiums, or empty shelves? Please report what you are seeing in your area in the comments section. It helps us all get a real picture of the physical market. In such a volatile environment, we can learn a great deal by observing the behavior of the smart money and their approach to risk management. In the midst of this volatility, it is easy to become swayed by rumors and misinformation. A perfect example occurred yesterday regarding Rick Rule, one of the most respected voices in natural resource investing. A rumor circulated that Mr. Rule had dumped his silver, causing panic among smaller retail investors who looked to him for guidance. The reality, upon closer examination, offers a masterclass in wealth preservation and risk management, principles that are particularly relevant for our generation. Rick Rule did not sell because he is bearish on silver. He sold 80% of his physical holdings to lock in substantial profits after a massive run-up. He recovered his initial capital and his tax obligations, but crucially, he redeployed that capital into silver mining stocks. This is a strategy of leverage. When the price of the metal rises, the profit margins of the mining companies expand disproportionately. If silver moves from $90 to $150, a mining company might see its stock price triple or quadruple. By moving from the metal to the miners, Mr. Rule is actually increasing his exposure to the upside while playing with house money. This incident teaches us two things. First, do not react to headlines without understanding the context. Second, the smart money is not exiting the sector. They are positioning themselves for the next, more explosive phase of the bull market. They are moving further out on the risk curve because they are confident that the trend is nowhere near finished. This leads us to the most critical question. What do the long-term valuation models tell us about the true fair value of silver? So, where's this all heading? If the banks are forced to cover, and if the dollar continues to lose its reserve status, what is the fair value of silver? To answer this, we look to the work of the investment firm VanEck and the economic models pioneered by the legendary Jim Sinclair. Sinclair was famous for predicting the gold run of the 1970s using a model that balanced the money supply against gold reserves. His logic was that eventually, for confidence to be restored in a currency, it must be implicitly backed by the gold held by the sovereign issuer. VanEck recently updated this model for the current economic landscape. They looked at the global M2 money supply, which includes cash, checking deposits, and easily convertible near money, and compared it to global gold reserves. The numbers are staggering. The model suggests that to fully back the global money supply today, gold would need to be priced at approximately $184,000 per ounce. Now, let us be clear. I am not suggesting gold will trade at $184,000 next week, or even next year. This is a theoretical model of fair value, in a scenario where the fiat system collapses and must be reset against hard assets. It is the ceiling of possibility. However, even if we achieve only a fraction of that reality, the implications for silver are profound. Historically, the gold to silver ratio, the number of silver ounces required to buy 1 ounce of gold, geologically sits around 15:1. In the modern financial era, it has fluctuated wildly, recently sitting near 80.1 and tightening to 60.1 during rallies. Let us apply conservative math to the VanEck forecast. If gold were to reach even half of that valuation, Or if the monetary system simply reprices gold to $20,000 or $50,000, and the gold to silver ratio compresses to a historical norm of 30.1 or 40.1, we are looking at silver prices in the thousands of dollars. Even using current numbers, if gold hits the VanEck target of $184,000 and the ratio stays at a conservative 60.1, silver would be priced at over $3,000 per ounce. When we view the market through this lens, the panic over a drop from $92 to $87 becomes absurd. We are arguing over pennies in front of a steamroller. The current price of silver is an anomaly created by paper leverage that is about to break. The upside potential is not 10% or 20%, it is multiples of the current price. We are looking at an asset that is mispriced by orders of magnitude. I know these numbers, $3,000 silver, sound impossible to most people, but look at the debt clock. Do you think a price target like that is crazy, or is it simply the result of hyperinflation? I'd love to hear your take on these valuation models. However, to view this solely as a monetary phenomenon is to miss half the picture. We must also confront the industrial singularity, a crisis of consumption that ensures the price floor will rise regardless of what the Federal Reserve does, and the corresponding regulatory risks that threaten every depositor in the banking system. We often talk about silver as money, but we must not forget its strategic indispensability. Silver is the most electrically conductive metal on the periodic table. It is not merely a precious metal, it is the lifeblood of the modern economy. Without silver, there are no solar panels, no electric vehicles, no advanced weaponry, and no 5G telecommunications. Here is the austere industrial vice that the banks ignored. Demand for these technologies is not optional, it is government mandated. The global push for net zero and the Green New Deal has created a voracious, inelastic demand for silver paste used in photovoltaics. In 2024 alone, the solar industry consumed nearly 20% of the entire annual global supply of silver. Projections for 2026 push that number closer to 30%. This creates a terrifying dynamic for the short sellers known as inelastic demand. If you're a jewelry maker and silver goes to $200, you might stop making silver rings. But if you are a manufacturer of Tomahawk cruise missiles or high-efficiency solar panels, the price of silver is irrelevant to your production decision. A few ounces of silver in a multi-million-dollar missile, or a government-subsidized solar array, is a negligible cost. These industries will pay $100, $200, or $500 per ounce because they must have the metal to operate. They cannot substitute it. This means that as shortages intensify, industrial giants like Tesla, Samsung, and defense contractors will effectively front-run the banks. They will bypass the COMEX and go directly to the mines to secure supply, draining the liquidity from the global market even faster. The banks are not just betting against gold bugs, they are betting against the entire industrial complex of the 21st century. Furthermore, we must address the bail-in risk that ties directly back to the bank insolvency we discussed earlier. If these banks are truly facing a $396 billion loss, a hole in their balance sheet they cannot fill, what happens to the depositors? Many of you believe the FDIC will protect you, or that the government will simply print money to bail out the banks as they did in 2008. But the rules have changed. Following the 2008 crisis, global regulators implemented the Dodd-Frank Act in the US and similar frameworks internationally. These laws moved the system from bailouts, using taxpayer money, to bail-ins, using creditor money. Here is the uncomfortable truth. When you deposit money in a bank, legally, that money is no longer yours. You become an unsecured creditor of the bank. If the bank fails due to massive losses in their precious metals division, the law allows them to seize a portion of unsecured deposits to recapitalize the institution. We saw this happen in Cyprus in 2013, where depositors woke up to find substantial percentages of their savings confiscated to save the bank. With the bullion banks leveraged to the hilt and facing insolvency from a silver squeeze, keeping significant capital within the banking system is a risk that offers no reward. By holding physical silver outside the banking system, you are not just investing. You are removing your wealth from the blast radius of a potential bail-in event. You are eliminating counterparty risk in a world where the counterparties are mathematically bankrupt. Does the thought of a bail-in, of the bank legally taking your savings to cover their bad bets, worry you? It certainly worries me. If you've already taken steps to secure your assets outside the system, you are ahead of 99% of the population. We are now approaching the endgame, leading us to our conclusion and the very real possibility of a force majeure event. The signals are flashing red across the dashboard of the global financial system. We have the central banks abandoning the dollar for gold, signaling the end of the debt-based hegemony. We have the commercial banks sitting on a $396 billion powder keg of short positions that they cannot cover without bankrupting themselves. We have the physical exchanges in Shanghai restricting trading to prevent a default. We have lease rates spiking to usury levels because there is no metal to borrow. The drop in price we witnessed yesterday was likely the last gasp of the suppression machine, a bear trap designed to shake the confidence of the weak hands. The banks know they are cornered. They know that once silver breaks $100 decisively, the psychological barrier breaks with it. The rush for physical metal will overwhelm the paper mechanism. At that point, we face the very real possibility of a force majeure. This is a legal clause that allows exchanges to settle contracts in cash rather than delivering the physical commodity, because the commodity simply aren't there. If you hold paper silver, an ETF, a futures contract, or an unallocated pool account, you may wake up one morning to find your position closed out at $90, while the physical metal trades on the street for $200 or $300. You will get your fiat currency back, but you will not get the silver, and you will not participate in the true wealth transfer. For those of us in the baby boomer generation, we have spent a lifetime building our savings. We have worked hard, paid our taxes, and followed the rules. We cannot afford to see our purchasing power evaporated by the desperate machinations of a banking system that has lost its way. The strategy, therefore, is one of patience and possession. Do not be shaken by volatility. Do not be scared out of your position by bank-manufactured dips. Ensure that your exposure is to the physical asset or to directly owned equities and high-quality producers, not to paper promises that can be broken with a keystroke. The $396 billion loss facing the banks is their problem. Do not make it yours by selling your insurance policy just before the house catches fire. The fundamentals are on our side. The history of money is on our side. And the math, as we have seen, is undeniable. Stay calm, stay diversified. And most importantly, hold the line. If you found this analysis helpful, please share this video with a friend who needs to wake up to what's happening. And don't forget to subscribe and turn on notifications so you don't miss the next update when the price moves again. Thank you.